All right, so what's up, guys? We are back again for part 2 of the previous chapter from the same book. It's going to be chapter 9, and it is Plan Your Trade and Trade Your Plan. So it's been a little bit of a long day for me, so I thought I would just come outside and actually get some air. We can get started. Hair is crazy, but I truly have no time to worry about or focus on things like that, because as stated before, it's progress over everything. All right, so here we go. We're gonna be consistent as fuck this year. So here we go again. Same book, same chapter, part 2. Let's go. All right, cool. So in the last video, we left off on patterns. So pretty much and we weren't done with patterns, so we're pretty much just going to jump right back into that. So the last video we talked about consolidations, breakouts, and breakdowns. We talked about triangle patterns. So hopefully you did a little bit of you did some due diligence of your own. You did your research and you further dug into that, and so we'll get started on the next portion here. All right, cool. So as mentioned, patterns are either a continuation or reversal. Reversal, as you know, means a trend changes direction. We'll talk about reversals as we progress. Please keep candlestick patterns in mind. Remember doji, such as evening star doji and morning star doji. How about the hanging man or the hammer? So these are actually these are all candlestick patterns, and so again, these are easily Googleable. So write it down, Google it. Doji pattern, evening star doji, morning star doji, hanging man, and hammer. Okay, so look those up. All right, so reversal patterns. The following trend reversal patterns are reliable and easy to spot. It's imperative you learn to spot trend reversals on both long-term and short-term time frames. I just feel like you guys are too far from me. Like, hold on. Let's go. Right. All right, I think that should be close enough. All right. Yeah, now I'm comfy as shit. All right, cool. The following trend reversal patterns are reliable and easy to spot. It's imperative you learn to spot trend reversals on both long-term and short-term time frames. After all, when a stock or an entire market is changing from bullish to bearish or bearish to bullish, you know how to take profits on current positions and prepare to open new ones in the direction of the new trend. The double bottom, cup with the handle, and reverse head and shoulders are bottom reversal patterns, with continuation patterns tacked on. You can study additional books on charting and find many more to add to these. When you first start trading, though, you'd be smart to learn 2 or 3 patterns and learn them well. Keep it simple. You'll make more money and have more fun. Double bottom pattern. This is one of my favorite bottom reversal patterns. It's one of the most powerful chart patterns for traders and works in various ways for all time frames. If you add 2 more legs in a V shape, you get a triple bottom. Triple bottoms are rare, but even more powerful than the double bottom. And 2 more legs, and you'll see a quadruple bottom, even better. Remember, the more times price tests support and doesn't penetrate it, the higher it can move if it breaks to the upside. The double bottom formation looks like a W. You'll see the pattern forming on daily charts when the stock is basing or bottoming. The pattern is only a bona fide double bottom when it is a complete W shape. After the double bottom completes its formation, the stock should pull back slightly, then move in a sideways consolidation pattern for a few days. The longer it consolidates, the more powerful the breakout should be. After the double bottom completes its formation, the stock should pull back slightly, then move in a sideways consolidation pattern for a few days. The longer it consolidates, the more powerful the breakout should be. When and if the stock breaks above the consolidated zone, On strong volume, buy 1/2 your intended position when the stock trades over resistance. During the initial pullback, monitor the volume. It should decrease. On the positive reversal day that ends the pullback on a daily chart, this would be a clear candlestick with a shaven head. Check the stock a few minutes before the market closes. Only if the stock is trading near the high of the day and the volume is strong, buy the second half of your position. If the stock doesn't close near its high on strong volume, don't buy. For a safer entry point, wait until the following day, which I call a nice spring day. When the stock trades a few cents over the reversal day's high, buy. And then there's a picture. So basically, the picture it's just explaining a double bottom. It would probably be, yeah, so it's basically explaining a double bottom and how it basically comes from a downtrend, creates a double bottom, bases, shoots up, comes down back to base, and then it shoots up again and then reverses into an uptrend. Next, very important, pullbacks have to halt, reverse, and then break above their own resistance to be playable. That's super important. Pullbacks have to halt, reverse, and then break above their own resistance to be playable. Those breakout days I call nice spring days are the safe points to enter. Once the stock trades a few cents over the reversal day, buying on the positive reversal day, meaning closing on high with increased volume, the day prior to the nice spring day is much higher risk. But as long as your risk-reward analysis is accurate and your stop order is in place, the play can yield nice profits. The daily chart on Lear Corporation, or LEA in the stock market, shows a double bottom pattern and then buying opportunities. So let me show you the diagram here. This page right here. Feel free to pause that and kind of study that if you need to. One reason the double bottom creates a great buying opportunity is the short squeeze that's created on the first few reversal days right after the retest holds and starts higher. The traders holding the stock short see that the downtrend may be ending, so they exit their short positions. That creates buying, with the bulls also buying. A stock in this pattern can shoot through price levels fast. The double top pattern mirrors the double bottom. I read that kind of funny, hold on. The double top pattern mirrors the double bottom and is shaped like an M. As positive as the double bottom formation is in foretelling a strong uptrend, a double top is equally negative and warns that a lethal downtrend may be brewing. Short sellers can sell when a weak stock penetrates consolidation. Hot tip, if you're not sure which way a stock will head when it's finished consolidating, check where it closes at the end of each consolidation day. Although there are no guarantees, a stock closing near its high for the day is positive. Closing near its daily lows suggests it may break lower. Check your overbought and oversold indicators for divergences. That was a little heavy, but we'll get into that stuff later. So short sellers can sell when a weak stock penetrates consolidation support. We'll talk about shorting techniques in Chapter 11 and show examples of double top patterns. Cup with handle pattern. William O'Neill, the founder of Investors Business Daily, named this pattern. It crops up on all time frames and can deliver nice profits. For core and swing trades, look for this pattern on daily charts when a stock is basing or bottoming. It resembles a side view of a coffee cup with a rounded bottom and handle, such as the pattern illustrated in Figure 9-11. Okay, cool. So they go on to show the cup and handle. Again, feel free to pause and study that if need be. When the cup with handle is complete, a period of consolidation will assure the pending breakout rises on a full head of steam. Once the price breaks above resistance formed by the top of the cup, the handle, and consolidation, buy on strong volume. So again, once the price breaks above resistance formed at the top of the cup, the handle and consolidation, buy when it's on strong volume. Buy 1/2 your position when the stock trades above resistance. By the second half when the pullback reverses into a nice spring day. For the safest entry, wait for the stock to trade 5 to 10 cents above the high of the nice spring day. Figure 9-13 shows a daily chart of Dow component DuPont, showing a cup with handle, subsequent breakout, and entry points. And then the explanation for the figure in 9-13 says, this daily chart of DuPont shows the huge chemical and technology company also selling off in January and into the first days of February. The only moving average on the chart is the 20-day moving average. You can clearly see the chart pattern with the sideways view of a cup with a handle. The pattern actually created an island reversal with a gap down at the beginning and a gap to the upside in the completion. The cup portion also shows a quick double bottom in January and February. You can buy early in the cup as it reverses to the upside. Note stochastic's bullish divergence and moves above and closes over the 20 moving average, but a safer place to buy is the completion of the handle or after it breaks out of its subsequent consolidation and heads into an uptrend. Hot tip. To enter a position trade, I plot stochastics on the middle scale and use its bullish divergence as one component of my entry strategy. Once I'm in the position trade, I replace stochastics with the MACD and watch its signals for a possible sell signal. Remember, with a zippy stock, stochastics can lose its predictive effectiveness by jumping quickly to its overbought zone and staying there. Of course, experienced traders will want to enter earlier as the handle moves up from its higher low. Reverse head and shoulders. In the chapter on shorting, we'll talk about the lethal top reversal pattern known as the head and shoulders. We need to mention the reverse head and shoulders at this point because it's a great bottom reversal pattern. Think of someone standing on his head. Now imagine the outline of his left shoulder, head, and right shoulder. For some reason, the reverse head and shoulders can be a confusing pattern for new traders to spot. My personal learning experience always reminds me of a coloring book my mother gave to me when I was a youngster. She pointed to a page drawn with nothing but large jungle leaves. "Can you find 12 monkeys in that jungle?" she asked. I remember staring at the page intently. Finally, one by one, the leaf formations revealed monkeys staring out at me. After a few minutes of concentration, I proudly pointed to all 12 monkeys. After you stare at charts long enough, reverse head and shoulders will start appearing here and there. With experience, you'll spot them as they are forming. They are potent patterns and offer excellent setup opportunities. Figure 9-14 illustrates the outline of a reverse head and shoulders. Let me show you that real quick. All right, so after you stare at charts long enough, reverse head and shoulders will start appearing here and there. With experience, you'll spot them as they are forming. So the neckline refers to the resistance that lines up across the pivot points of the dips that form the shoulders and head. A price break and close above the neckline is generally the safest entry point for a long position trade. Figure 9-15 displays a daily chart of the Chevron Corporation and a reverse head and shoulders pattern that led to a profit-making move. So I would maybe pause this and just really look at that for a moment. Okay. Plain vanilla breakout. As you know, every stock has a different personality. When a stock wanders sideways in a basing formation, it may not develop a cup with handle or a double bottom. It may just consolidate until good news, earnings, or accumulation propel it higher. It's still very playable. In fact, I like these patterns better as entry points are easy to determine. Hot tip. Sometimes bases form in shallow, rounded bottoms. We call these patterns saucers. The tighter and more orderly the consolidation pattern, the lower the risk. As long as it fits your top-down criteria and pushes above the highs of the base resistance price zone, you can play it for intraday, swing, or position trades. United Technologies had it itchy there. All right, United Technologies Corporation breaking out of a clear-cut base and shooting into an easily defined uptrend is what figure 9-16 that I just showed you was showing. Yeah, traders profited 5 solid points in this trade, offered by a steady but steep rise higher. Hot tip. Many fund managers track stocks bouncing off their 50-day moving averages and their 200-day moving averages on daily charts. If you find a stock springing off its rising 50 moving average at the same time as that the market is breaking out, it could prove to be a terrific entry for a profitable intraday and or swing trade. Know your stop before you shop. In a class I was teaching a few years ago, I talked to a young man whom I knew had steadily lost money. Still, he hung on. He showed me a day trade he was playing. It looked risky to me, and out of habit, I asked, "Where's your stop?" He blushed and shrugged. As much as I like him, I knew from experience that trading without stops would whittle his account down to bedrock as surely as the Colorado River etched out the Grand Canyon. Unfortunately, I was right. This young man blew his entire account and had to go back to his original day job. Since then, I've seen this happen over and over again to traders who ignore risk management. As I stressed before, the trick with stops, no matter what time frame you're trading, is to write them down before you enter a trade. Your best bet is to enter an automatic stop order with your broker immediately after taking a trade. When the stock I can speak from experience, I used to not use stop losses, and I would blow a lot of accounts, like $20,000 one month. When the stock you're playing hits your stop, that's where the rubber meets the road. That's when you arrive face to face with the emotions we discussed in chapter 4, fear. Fear is the right thing to do. Back up. It says fear. Is this the right thing to do? Need to be right. I don't have to sell now. This is a good company. Or there's greed. If I sell now, I'll take a loss. Or I'll wait until it bounces. Hope. In just a minute, the futures will hit support. If I get lucky, they'll bounce and this stock will recover with the futures. Please shut your ears to these voices, no matter how insistent and tantalizing they are. When your stock hits a stop, execute your sell order swiftly. Hot tip. If you see volume coming into an orderly base and the stock doesn't move lower and your top-down criteria is in agreement, buy an initial lot to get an early start on the potential breakout. Enter an automatic stop with your broker just under the base support low. When your stock hits its stop, execute your sell order swiftly, robot-like, with no emotion. The trader saying, "Your first loss is your smallest loss," is mighty accurate. First and foremost, if you instituted the risk management strategy listed in Chapter 3 that stated you would risk no more than 2% of your account equity on a single trade, adjust your shares for each trade to conform to that strategy. For position and swing trades, place your initial stop loss order 10 cents to 70 cents below the intraday's low, or 25 cents below intraday support, adjusted for stock's volatility on a 60-minute chart. Please use common sense. If you're trading a $50 stock with an average price range of $1.50 per day, then you have to give it a wider stop, say 50 to 75 cents under support, to allow for volatility. Then you do a quiet $10 stock. That was written odd. If you're trading a $50 stock with an average price range of $1.50 per day, you have to give it a wider stop, 50 to 75 cents under support, to allow for volatility. Then you do a quiet $10 stock. I am not really sure why that's written like that exactly. The $10 stock may move in an average price range of 50 cents per day, so a 20-cent stop below the support level would work well. As your stock moves up, establish a trailing stop if you're able to. Not every platform has that. Whenever the stock progresses through a continuation pattern and then moves higher, pull your trailing stop up and place it 25 to 50 cents under the continuation pattern's low support zone. You can just kind of manually obviously do that as well if there's not an actual trailing stop feature on the platform that you trade on, the exchange. That way you won't give back your profits if the stock decides to make an unexpected dive. Of course, you can trail your stop under a trend line of a 20-day moving average if you wish. Here's an alternative stop method for position trades. Okay. Adhere to the stop loss method just discussed until your stock's uptrend makes at least 2 pullbacks and 2 prominent highs. Then, draw a trend line connecting the lows of the pullbacks as we discussed in Chapter 5. Next, draw a channel line connecting the highs as shown in Figure 9-16, which you guys already saw. Just as the bottom trend line acts as support when you connect 2 or more highs with the top channel line, it defines the resistance area where the new highs of the uptrend will likely reverse. What the fuck? Does the stock need something? All right, the next time your stock on the daily chart approaches this upper channel line yet fails to touch it, consider taking a portion of your profits. If the right conditions prevail, you can buy the shares back when or if it bounces off of the lower trend line. This way, though, you've locked in gains and the rest is gravy. If you want to take profits early on, wait until you make 1 or 2 points, then sell half or 2/3 of your position. If the stock continues to defy gravity, replace those shares at the pullback bounce. Hot tip: ultra strong stocks experiencing a mega steep breakout may rise 3 days in a row. When swing trading at the end of the 3rd day, the stock is considered overbought. By the 4th day, expect it to retrace or pull back. Depending on the market conditions and trading time frames, traders should consider taking half or all of their profits at the end of the 3rd day. Another profit point, particularly for swing trades: if your stock goes ballistic and gaps open to the upside 2 days in a row, grab your profits at the end of the 2nd gap day, 3rd day up. On the 2nd gap open, shorts and sellers wait right around the corner, drooling and sharpening their claws. Few things are more irritating than riding a stock up to sky-high profits than holding on while it drops back to your entry price, or worse, to your old stop. Time stop. Say you take a trade and after 2 to 4 days, sooner if you prefer, the stock hasn't moved in the direction you predicted. Although it hasn't touched your stop loss point, perhaps it's acting listless or drifting lower. If you also see a negative market environment, you may want to lighten up on your lot size. Final stop loss point and exit. Lots of interesting noises. If your long position trade makes a lower low, that's the absolute deadline for you to exit the trade. Remember, the definition of an uptrend is a stock climbing in higher highs and higher lows. If a stock makes a lower low than a previous pivot low, the uptrend is broken. These stop loss points and exit strategies come with a caveat. If CNBC suddenly announces a highly negative global event, or the Fed chief appears on the screen and utters the word inflation, or says tighten interest rates, tighten your stops or exit. That is literally happening right now. Don't wait for your stocks to crash and burn. Take profits fast. Then you can cluck sympathetically and hold the door open for the squealing slow pokes. Here's a checklist to guide you through position and swing trade entries. You may want to keep it next to your computer. Remember, before you run through the checklist and place your order, your top-down criteria should be satisfied. We talked about top-down criteria yesterday, so just if you forgot about that, just go back and review. The more you review, the better. It is never a bad thing to review more than once or even twice. It'll just help you to really lock in the knowledge that you're learning, and sometimes you don't even understand it the first time you're hearing it. So you know, with experience comes a better understanding of the education that you're receiving. So not a bad thing. Just go back and listen to that again if you don't remember about top-down trading. All right, buy checklists for position trades. All right, so she's got a checklist. Number 1, enter stock, or I'm sorry, either stock is in an uptrend, meaning it's experiencing higher highs and higher lows, or it shows strong evidence of breaking out and initiating an uptrend on a daily chart. Number 2, stock is trading over its rising 50 and 200-day moving averages. It's optimum if it's bouncing off of a 20-day moving average. If you are bottom fishing, the stock should be trading above its 20-day moving average. 3, moving averages are layered in proper order. 20-day moving average above 50-day moving average, and 50-day moving average above the 200 moving average. Not inverted except in cases bottom fishing. Then buy only when it has closed above its 20-day moving average. Number 4, entry day shows strong volume. Number 5, stochastics CCI or MACD displays oversold reading and hooks up in a bullish divergence or is trending higher. Number 6, perform your risk reward analysis. Use entry, stop, and profit target prices. The stock's initial move should offer a 1-to-3 risk reward ratio. This is number 7. Number 7, if all conditions read go, when stock trades 1 to 10 cents above initial breakout resistance, buy 1/2 of your intended position. Number 8, buy the second half of position on a pullback reversal day only if your stock is closing near the day's high on strong volume. Number 9, or you can buy the second half of a position when nice spring days trade above pullback reversal day's high. Number 10, adjust stop loss between 25 cents and 70 cents, no more than $1.50 under nearby support. Number 11, when the second pivot low from bottom is established, draw a trend line under the lows. Establish your risk strategy. Stop loss under each succeeding consolidation support, or under initial trend line, or under the 20-day moving average. There's another or 30-day moving average if a wider stop is preferred. Like fly, go away. Close position if the stock closes below the trend line or moving average on its daily chart. Close the position if the stock closes below the trend line or moving average on its daily chart. From now on, you'll see the entry price stated as buy when the stock trades 1 to 10 cents above resistance. Again, and always, please use common sense. The entry just above resistance simply assures that other traders are willing to buy at a higher price than nearby resistance highs. With some volatile stocks, no matter how fast you enter your order, the price may jump missile-like. It may take 10 cents above the breakout price to have your order filled. I specified 10 cents as a limit to remind you not to chase the price higher and higher. You will miss entries. It's part of trading. Let the price run without you and wait for another opportunity there or elsewhere. In Chapter 10, we will look at additional chart patterns and buy criteria that apply to both swing trades and day trades. And that concludes this chapter. And at the very end, there is a center point. Practice healthy selfishness. Do you want to be a power in the world? Then be yourself. Be true to the highest within your soul, and then allow yourself to be governed by no customs or conventionalities or arbitrary artificial rules that are not founded on principle. Ralph Waldo Emerson. The quest for self-understanding takes time and effort. Those who believe time spent dwelling on inner growth is selfish may want to reconsider that supposition. To achieve balance and true power, we must travel the inner and outer path. Either one by itself will not take us where we need to go. The inner path is the most difficult. It's the path of self-knowledge and the consciousness development. We've explored and transformed the frontiers of the outer world magnificently in the last 2 centuries. We've dissected the atom and delved into its secrets. We've invented wonderful gadgets, machines, and computer networks to modernize our lives. We've landed on the moon and sent cameras and telescopes to explore distant planets. The Hubble telescope revealed that the universe is bigger and older than we thought it was. Indeed, we humans find it quite acceptable to spend time investigating our outer world, yet we've scarcely inquired into the other frontier, ourselves, and our unique inner space. Those who take time to reflect and study their own emotions, beliefs, and personal goals may appear selfish to those around them, yet it is truly selfish to spend time exploring your backtrack, this is a question. Yet, is it truly selfish to spend time exploring your own potential? Is it selfish to learn your own power and discover your highest possibilities? Is it selfish to live fully with a deep inner sense of meaning and satisfaction gained from self-knowledge? Is it virtuous to remain unaware of our deepest belief systems? Is it healthy to live in inner darkness instead of inner light? It's impossible to give to others what we ourselves don't have. We only forgive fully once we've forgiven ourselves. We only love truly when we love ourselves. We give authentic support, peace, and joy only when we bring them up from our own internal well of strength, serenity, and happiness. We can share more good and enrich the lives of others if we spend time knowing, forgiving, and loving ourselves. Healthy selfishness not only improves our own experience, but it improves the world around us. Cool. So that's it for today. There's also a quiz at the very end of all of these chapters. I'm gonna show this to you, and then you can feel free to actually take this, like pause, take a screenshot or whatever, and then you can take this quiz yourself. So let's do this first portion here. Pause. All right, so if you want to take that quiz, go ahead. But cool, so we finished that chapter. The next one is going to be 10. And then like we discussed before, consistency is key. So we're going to be back tomorrow to read chapter 10. So come back and join me. And again, progress over everything and stay consistent. So I'll see you guys next time. Be careful in the market. Make sure, plan your trade your plan. All right, see you guys next time.